link. All right, is it 6? Wow, 6:01. Started a minute late. All right, guys, you survived the rain. I told you, I think I made a comment last time when we had this, was the first class we had with no rain. It seems to rain every single time we do the class. It's kind of crazy. So going through the disclosures again, don't change anything that you have of your personal investments, legal documents, what have you, until you actually meet with a professional, whether it be a CPA, an attorney, a financial advisor, what have you. So in other words, don't make changes based off of what you learned from the class. Hopefully the class is giving you some ideas of things to look at, but don't make those changes. All right? Tonight we're going to talk about investing during retirement. At the break, we're going to go through and have you fill out your evaluation form, and you'll have an opportunity to go through and set a lab session. All right? I think we're going to have somebody from our office also come in, because there's so many of you that we'll have 2 people that you can get together with and set up the lab sessions if you'd like. On the lab sessions, just to let you know, again, I think I made this comment, that we do have it at the office just right down the street on Okeechobee and Salisbury. We do not do them here. And I do them on Tuesday, Wednesdays, and Thursdays, usually from like 9:30 to about 3 is the timeline. I'm going to ask you, though, if you go through and set the lab session, please keep the lab session or let us know well in advance that you don't want it, because I only give so many hours a week to actually seeing our clients, and so these lab sessions take that time. And so when you book it and then you cancel, it kind of leaves everybody out in the cold, so that kind of stinks. And if you're wanting any of the reports run, if you want to know like when's the best time to take your Social Security, if you're trying to understand like how much I convert from the IRA to the Roth IRA, please let them know when you're going through and confirming your lab session so that we can have you send us the appropriate documents we need to run those reports for you, so that when you're there we can give you the report. If not, then it ends up being 2, because we'll do the lab session, then you'll end up getting the stuff back to us, we'll run the report, and then we send it to you. But I'm just going to send you the report and not be able to cover it with you. Okay, so this way we'll have the report and we can cover it, so you can kind of make heads or tails of it, and you'll have it and it's yours. All right? And then we're going to finish out after the break with income planning. So I went through and took out about 44 slides of tonight's presentation to try and make it a little bit nicer, I guess you could say, because again, we've been getting a lot of feedback that it's just too much information. But there are some parts tonight that I do want to actually show you the graphs and the numbers so that you get a better idea. But everything I'm going to talk about is, of course, in your book, and you can somewhat follow along, because I did not move the slides. I actually started during that early. I started moving things up, and I was like, you know what, I'm going to leave them the way they are in the book. So to me, it's a little choppy how we're going to go through this, but I think it's great information. It's one of my favorite parts to go through and do, because I do like talking about the different investment strategies so that you guys can get maybe a better handle on how things work, and then how you can use those in retirement. So we're going to cover the first part of investing. We're going to talk about the types of financial institutions, which there's basically 3. There is the stock market, there's banks, and there's insurance companies. Those are the 3 opportunities that you have, okay? So we're going to break each of those down, hopefully in a little bit simpler way to understand it. We're going to talk about investment risk. We're going to talk about different types of actually managing the investments, whether it be a traditional asset allocation versus active, so buy and hold versus actively managing, or tactical, which is jumping in and jumping out of the market, trying to actually time it, okay? And I'll show you some stuff on how each of those work, and then how to handle today's volatility, right? So, what is the best investment? Any idea? ETFs, right? Anybody else?
The one that works for you.
The one that works for you. So I was with a bunch of actuaries a couple of weeks ago, and I asked the same question, and one of the actuaries said, we should all invest in taxes. They just keep going up. And I liked it, because there really is no best investment, right? And so that's what we're going to talk about tonight, is basically trying to get your money to work for you rather than you work for money. So if you had a job or have a job, and you turn around and you put money into your 401k or into your retirement plan, your IRA, whatever, you're basically working for money. Now the whole idea is, how do you get the money to start to work for you? Right? Reflecting back to Shark Tank again, if you watch Shark Tank, Mr. Wonderful always calls his dollars soldiers. So if I send my soldiers out, when am I going to get my soldiers back? Right? because he wants them to go out and earn interest and then come back to him so he has that money to be able to send back out and earn more interest. He has his money working for him. He doesn't want to go through and tie it up, right? So that's what we're going to kind of go through and talk, and so you can start to get the idea of having your money work for you. Banks. Josh knows a lot about banks because that's where he works, right? So the thing I want you to understand about banks, because most people do understand banks, right? We have checking accounts there, we have savings accounts, we have CDs, we have very protected type of investments in banks. But what happens is when you turn around and you take your money and you deposit it in the bank does not keep it there. They are going to give it out into loans. They're going to do car loans, they're going to do home loans, they're going to do credit cards, right? The cash is not there. So if you're thinking about robbing the bank, don't do it because there's really nothing there. It's all gone. But because of the fact that they're lending that money out, and they would have to go and repo or go after that person to collect that money back if that person doesn't make the payment to them, that puts all the risk on their shoulders. So because they're carrying all the risk, they're not going to give you a whole lot of return. Does that make sense? So if you're dealing with banks, because they are something that you need to deal with, I mean, we all end up using them at one point or another, just understand that they carry the risk. So it's all in it. So if you go in and Josh having a bad day, it's probably because they, had somebody not pay their mortgage or their car payment. They're telling him to call and go after it and whatever. And that's not very fun, especially on a rainy day, right, Josh?
How do you know?
So banks carry all the risk. You are just going through and being able to utilize what they go through and do. FDIC, because sometimes people ask about FDIC. FDIC covers up to $250,000 worth of deposits. It does not cover a penny of interest. And that's very confusing for a lot of people. So they think if they put $100,000 in, it goes to $125,000. Something happens to that bank, they're insured for $125,000. Nope, only for the $100,000 that you put in. Just want to throw that out there so that you understand on the FDIC. Who is FDIC? Anybody have an idea? What is FDIC? What do the letters stand for? So what's the C? Federally Deposit Insurance Corporation. Well, federally deposited sounds like the federal government. Federally deposited. It's insurance. And it's a corporation. Our government's not a corporation. So who is it? You guys been to D.C.? Walked around the monuments? Because there's a whole FDIC monument on the south east corner. It's AIG. The insurance company AIG is FDIC. Oh, wow. Josh didn't know. So what's crazy is that a few years back, there was a big issue in Europe, and FDIC had to pay out a lot of money to cover those banks that had the challenges in Europe. So they came back to the United States and they said, hey, we need to go through and assess all of the banks that are participating in FDIC to go through and revamp ourselves to cover some $1 trillion of money that was lost over in Europe. And our government not only said no, but hell no. And FDIC said, well, no problem, we're out of business. Could you imagine if FDIC went out of business, how the banks would have a run on everything? Okay, so the government said, and that's I think what FDIC came back to me. I just said, well, then, you know what? Do you understand the run that you're going to be dealing with? So the government said, well, boy, we can figure something else out, and they came up with the very first bailout. And as soon as they did the first bailout, then every bailout after that started really falling in line with General Motors and the airlines and everybody else. Right? Kind of an interesting little history deal there. So FDIC, I also thought was pretty interesting that we had set up a foundation, I think I mentioned, and we started helping a lot of wartime veterans be able to get benefits. And so we were able to go through and transfer assets for these guys or girls to be able to get them these benefits. But we weren't allowed to transfer them into FDIC. And that puzzled me. Why would the government say you cannot take the veterans' money and put it into an FDIC account and get them benefits? So I started researching it more and more. Josh, have you researched it? As far as if you made a claim with the FDIC, how long does FDIC have to pay you back and make you whole?
I want to say something 5 to 10 years.
36 months, 3 years.
3 years.
It's a long time. 3 years to make you whole. So you're talking about wartime veterans who could be sick and are needing care. The government, federal government said, no, we won't let you go into banks with that money and qualify for these benefits, because if the bank were to falter, fail, or go out, we can't have you waiting 36 months to get your money. So what did they do? They told them they had to put the money into insurance. Kind of interesting, right? So again, just another little fact. But banks are secure. Banks usually carry all the risk, and so now you'll have an understanding of that. Wall Street, the stock market, right? The stock market offers various types of investments, and then they blend a lot of investments together, and they seem to have three definitions or three names for everything that they do. So it just kind of makes it confusing. But I'm hopefully going to break it down and make it a little bit easier to understand. So, stocks. Is there anybody in here that does not own a house? You don't own a house. Have you owned a house before?
Yeah.
Okay. Anybody else not own a house? All right. So you all own houses. You all have stock, except for me, in real estate. So think about it. You bought your house. You do the maintenance. You go through and maybe do improvements, and you're hoping to sell it for more later than you bought it for. That's a stock. That's as simple as it is. So I'm not saying go buy the stock. I'm just throwing it out there as a name. Let's say you go buy Apple, okay? And the only reason why I picked them is because of the fact that they have a really good maintenance program. So if you've bought any type of Apple products before, and you've had it break and you need to have it serviced, they're pretty good at handling it. And if they don't service it, they just send you a new one, okay? So if you decide to buy into Apple, you're hoping they're going to maintain with their maintenance plans. You're hoping they're going to continue with their new product services, with coming out with new technology, and you're hoping that maybe you can sell it for more later than you bought it for. Same as you do with your house. That's a stock, right? Now, just thinking about it, if you decide to go buy a stock of a company that you have no idea what they really do, how good they are at ordering inventory, how good they are at management, how good they are at paying their taxes, well, then that would be a pretty risky stock, right? If you decide to buy somebody who's been around for a long time and really knows their stuff, well, then that's a pretty decent stock. So there's nothing to me that's scary about a stock if you think about it as what you've done with your house. It's just the exact same thing. But you're actually going through and buying and owning the piece of that, right? So you own that share of that stock. Bonds, you're actually lending money out. You are the bank, okay? So I'm going to pick Walmart as an example because Walmart actually borrows a lot of money. Now, the government borrows money on bonds and corporations borrow money. Why would Walmart want to borrow money from you guys? And what would they use it for? What do they pay? Walmart, right now things are a little off, but usually Walmart, even in kind of a down time, will go through and pay like 4.5% for like 5 years to borrow your money. So what they do with that is they turn around and they pay payroll and they buy inventory. So here's a pretty easy little rule of thumb. If you can make more money or more interest off of your money than you have to pay somebody to borrow theirs, always borrow theirs. So if you can borrow money at 2%, but you're going to make 5, always borrow somebody else's money. Now, if it's reversed and you got to pay them 5 and you're only getting 2, well then don't borrow their money. That's putting you backwards. Walmart is going to make a heck of a lot more money than 4.5% because they'll take their profits and they will open new stores. They'll open new distribution centers. That's where their focus is expanding and growing that way. And so they'll borrow money just to cover their inventory and their payroll, right? It's much cheaper than going to the bank and borrowing because Josh, I mean, you go see him, he wants like 10% for a commercial loan. So that's why they'll go through and do that. So you can do corporate bonds where you're actually lending them the money. Now, what's interesting about bonds is I call it the totem pole. So what if the company were to go out of business? Where do you stand with the money that you gave to that company? Well, the totem pole goes that the very first amount of money, because if the business goes out, they're still going to have probably inventory, equipment, real estate. It's called a floor. They're going to have some type of a floor that they're going to need to liquidate and move out, or somebody else is going to buy that whole floor, take them over, whatever, right? So whenever they receive money after they declared bankruptcy, the first money they come into has to pay the last 2 weeks of payroll. So their employees aren't out, okay? So that's the top of the totem pole. The very next of the totem pole comes down to any banks that they have borrowed money from. Well, I just told you, they're not going to borrow money from banks because it's too high of an interest rate. So usually there's nothing going to banks. The next one on the totem pole is all the bondholders. That's pretty decent. It's right there at the top. Who's next? The IRS. The IRS. So this is one of the only times I've ever seen that the IRS actually puts people above them. It's kind of interesting, okay? Then the next one comes into any merchants. Can't think of the name. Anybody that they've borrowed or have bought inventory from, then they get paid back. And then after that, anything that's left, as we say, kind of in the bottom of the barrel, would go actually out to any of the stockholders. Okay? A lot of times there's nothing left by the time you get to that point. Okay? So bonds are pretty interesting because of the fact that they're lending money out. And so again, if you're going to go with a pretty decent company, there's probably a decent chance you're going to get your money back. Have you guys heard the term junk bond? Yeah? What a junk bond is it's a company that maybe either is pretty new, doesn't have decent management, maybe it's selling products that not everybody wants in their neighborhood, maybe they've faltered on their taxes, maybe they've had bad management, maybe they've had whatever the situation is, that they might not be able to pay you your interest. Because understand, if you do that bond at 4.5% for 5 years, you get 4.5% every year, and at the end of the 5 years, you get all your money back. So if they're a bad rated bond, they may not be able to pay you your money per month, or they may not be able to give you your money back at the end. And if either one of those situations comes into play, would you be okay just getting 4.5%? Or are you going to go, wait a minute, if I got that kind of risk, I want like 12. I want some skin here, right? So if they have any type of a rating that they may have a challenge paying your money or giving your money back, they're a junk bond. You know what our neat industry did? They said, wait a minute, everybody knows what junk bonds are. You guys all shook your heads yes. So you know what they did 3 years ago? They changed the name. Now, when you get interest off of a stock, it's interest. When you get interest off of a bond, it's yield. So when you get yield and you're going to ask for more, it's called a high yield bond now. It's crazy how many people go, I would like to buy 100,000 high yield bonds. And so which junk bond do you want me to buy? I don't want any junk bonds. I want the high yield bond. Isn't that crazy? Just by changing the name, people don't understand what happened. So just be aware of that you're going to want to buy into something decent. Now the government used to be the strongest lender of, or borrower of bonds, and they just got demoted from the AAA plus to AAA. Isn't that interesting? That our government actually got demoted on their credit score. But typically, government bonds are pretty simple, easy way to go. And so when you're in retirement and you're trying to generate income, that might be a way to do it. Okay? Don't have the market risk, the market volatility. You have the opportunity to receive interest on a given basis. You know that however much money you put in there is going to pay you that interest. And so it's kind of a nice way to create a paycheck coming from the money that's in the bonds. Okay? Mutual funds. That is, I think, the most popular product that everybody knows because all 401ks are made up of mutual funds. So unless you're specifically paying a overlaying fee to have somebody manage your 401k, which most 401ks don't even allow it, right? You are probably in mutual funds. And so mutual funds are what they consider open-ended. And so what happens is you have these money concepts because it's actually done out of a prospectus. It's actually regulated totally different than the stock market is. But they come up with a perspective of what they're going to go through and do as a core investment, okay? And then you make the decision of whether you like that strategy or you don't. So let's say you wanted to just go like all green. You could buy an all green mutual fund, or you want to go with something that had nothing to do with like tobacco or guns. You could buy that type of a mutual fund, right? But what they're going to do is they're going to do either 100% stocks, they're going to do 100% bonds, or they're going to do a combination between them. but they're going to structure that mutual fund with those types of holdings. Okay? One thing about a mutual fund is that you cannot make any decisions on the investment side of the mutual fund itself. You either hold it or you sell the whole thing. Okay? So let me give you an example of when you maybe would not have wanted to have a mutual fund. We just went through COVID. We were just told in 2020, March, that the entire economy was going to shut down. That's pretty good knowledge to go, hey, should I still stay in the market or should I not be in the market, right? So in this mutual fund, and I could pretty much bet every one of you that has a mutual fund holds these 4 companies in that mutual fund, okay? Unless you're just 100% bonds, you probably hold these 4 companies. And I'm going to ask you just to think about, because I say this isn't rocket science, maybe that's the wrong thing to say, but just logically thinking about this, if the country is going to shut down and everybody's going to be at home, except for Miss Shell because she's essential personnel, she'd have to go in, right? She's a nurse. Only the essential personnel is going to be working. And these are the 4 companies you hold. Would you want to hold these, sell them, sell some, buy more? Right? Here's the 4. Delta Airlines, Royal Caribbean, Amazon, Home Depot. You know all of them. Would you want to sell all of them because you know the entire economy is shutting down? Okay. Would you want to sell some of them? Which ones? Service, right? Service wasn't going to be happening. Anything had to do with service. Disney, Cisco Foods, anything had to do with service because nobody was going to get to use the service. And if you think about some of that service, like Delta Airlines, they could just go through and park the airplanes on the ramp and lock the door. But like Royal Caribbean, that's a big freaking deal because they had to keep crew on those ships. Those ships had to stay lit. They had to keep pumping water. They had to keep doing it. So there was an expense besides not having customers, right? So I'm going to sell that one first. Who would you like to buy? Everybody's at home.
Right.
Everybody's at home. And what are they going to do? Probably their honey-do list, right? So they're probably going to buy everything from Home Depot, but you can't go to Home Depot, so you're going to buy Home Depot off Amazon. Right? As I said, it's not rocket science. It's pretty logical when you look at that. If it's a case where you're looking at buying into a company that sells snowboards, well, would you want to hold them all year long? I mean, do people snowboard in the summer? So maybe you buy like skateboards. What about like if we had all the problems with the chips for the cars, and now people aren't buying cars? What about now where interest rates are so high and people aren't buying cars, new cars? Would you want to hold stock in new cars? Or you think you might want to hold stock in parts? People have to repair the ones that they have, right? So this is just kind of the thinking of how is the money actually flowing, right? But in a mutual fund, you have no choice. You're going to hold everything it has. You're either going to hold it all or you're going to sell it all, okay? Because who made a lot of money during COVID? How did you guys see the doctor? Zoom. Zoom. Now we've been using a form of Zoom for almost 20 years, but Zoom all of a sudden became like the hottest thing. So the telecommunication side of things really, really went up. Students, you know, that type of thing. I mean, it was just really crazy. So yeah, there was a lot of areas that we're going through and making money, right? So they're open-ended, which means that the company that is putting all of these together, that's taking your money in, at any time when you guys say sell, they have to buy it back. It does not have to go to the open market and find a buyer. It's open-ended, which means that they will always buy it back from you, okay? So if all of a sudden the stock market's dropping 700 points and you freak out at lunchtime and you call your broker and say, sell my mutual funds, right? They would have to buy it back. However, because it's open-ended and they have to buy it back, the SEC wants to make it fair for you as the client and fair for the company. So the way they make it fair so the company cannot go through, like you place that call, they decide to wait 20 more minutes before they sell it, maybe they make several more $1,000s, right? So for that not to happen, they made through the ruling that all mutual funds are bought and sold at the closing bell of the market day. Therefore, nobody can mess with the numbers. Okay? There's no inflating them, no decreasing them. Whatever the value is at the closing bell, that's what you'd sell it at. Whatever at the closing bell, that's what new people buy it at. Okay? And that's how they regulate that. Now, what I think is kind of interesting is that our government says, hey, at 59 and a half years old, you can take your mutual funds out of your 401k and move it to your own IRA. You don't have to keep it as the employer in that mutual fund. You can move it to your own IRA. And when you move it to your own IRA, you can now buy whatever you want to buy. You don't have to stay, and they're hoping you're not going to stay in mutual funds. But it's crazy, I see so many people do that move and then just buy mutual funds because it's what they know. But the idea is, they realize that if the mutual funds go down, it'll take like 10 years for them to come back up in most situations when you look at history. Now, it didn't over COVID. They came back in about 6 months, 7 months. But for most cases, it could take 10 years for them to come back, and most people at 59 and a half don't have 10 years to wait for it to come back, so they're saying, hey, you can move it out, start granting, do what you want to do. Now, what's their interest? Why do they want you to move out of the mutual funds? Because you're getting close to them starting to take taxes on those money, right? They want the account to be worth more, so they can get more tax. So that's why they're doing it. But it sounds good. They're letting you move it so that you can make your decisions. Now, let's say that your company says, no, you cannot move your mutual funds till you end service. Some still are. Very few. Very few. Because that becomes discrimination. If you're in a company that will not let you move your mutual funds out at 59 and a half, and that mutual fund does not perform the way you think it should perform, you have the right to go back and sue the employer. Because the employer picked the mutual fund. They picked the company that picked the mutual fund, right? And they're saying, this is our program, this is what you have to participate in. And you say, well, it didn't do half as good as what this program would have done, and you can sue them. So, off of the discrimination rules, they came up and said, all right, you can move it at 59 and a half, and now you can't sue us if it doesn't perform. Pretty cool, I think. I'm going to talk about this in a second. ETFs. That's what Josh said, if you got what the best investments. I'll have to kind of wait towards that too. Because an ETF is a combination of stocks and bonds, or all stocks or all bonds. Okay? It's a combination, just like a mutual fund. So they're very, very similar. But this is close-ended. So if you want to sell your ETF, you have to sell it over the stock exchange to a buyer. Right? So if the market's going down 700 points, you call at lunch and say, sell my ETF. They're going to put it on the block and they're going to sell it to the next buyer. So you could actually get out of it. Okay? You would tell them at what amount you want to sell it at. So let's say it's trading right now at like 130. You could say, sell it at 125 if it goes that far down. You know, and then once it hits 125, that's what they're going to sell it at. Okay? So you have some control of that. But the cool thing about an ETF is, let's think of it being in a wrapper. Okay? It's in this wrapper. But we have those 4 holdings in there if you happen to pick that type of an ETF that holds Delta Airlines, Royal Caribbean, Home Depot, and Amazon, right? And COVID's coming along for a second time, let's hope not. You could actually go and decide to sell inside of here those different holdings and buy more without interrupting the other holdings of the ETF. You can pop or open the wrapper, okay? Now, there is a money manager that is picking the funds that are in this ETF. The second you make a decision to trade on one of the funds inside of that wrapper, and you open the wrapper, now you are managing all of the holdings. The money manager is not going to make any decisions anymore for you on any of those. Okay? But you decide to do that, and after you've made that trade and done what you want to do, you turn around and you click back in or call or whatever, and you rebuy back the ETF, and guess what it does? It gathers up all the things that were there and puts it back into the wrapper again. Pretty interesting. But you could hold more, you could hold those stocks outside of it if you wanted to. Okay? Or you could sell some of them and buy more and hold those outside of that wrapper and then put that in that wrapper, and now you'd hold those holdings just as individual stocks. So you can do that. The other thing I like about the ETFs is that a lot of times when people come and they say, hey, I want to get my grandchild started, or I want to get my kids going on something, I would do an ETF.
What does that stand for?
Electronically traded fund. Electronically traded fund.
No load and management fees like the mutual fund.
Depending. Yes. So Jerry's saying that they're less expensive than the mutual funds. And yes and no. Okay, because these can have management fees also. You have to check and see where they're at. But they don't have fees going in them. They don't have loads, as he's saying. So sometimes when you do these outside of work, they can go through and charge you so much to go into it. If you take money and earn it and reinvest it, they can even charge you more money on that. So that's kind of another ball game. But yes, mutual funds I think are expensive and not as well performing as probably an ETF. And that's if you want to do it yourself and not actually go and pick straight stocks and bonds yourself. Now, are you guys familiar with, or maybe you've picked inside of your retirement plan at work, like the 2030 fund, 2040 fund, 2065 fund? What are those? They're mutual funds, okay? And what they're doing, and this is the misconception, because let's say you're going to retire in 2030, so you say, well, I'm going to retire in 2030, so I'm going to put all my money in the 2030 fund. But the fund is actually set up stating that if you take the 230 fund, that means that's the date that you want all of the money in your pocket, okay? And so you're probably going to be in retirement for a lot longer than just 2030, so you probably would want to extend out much farther, or don't do them at all. But basically what they are, combination again of stocks and bonds. And so if you're in, let's say, a 2030, we're not very far from 2030, which is kind of scary. But in that situation, it's going to buy more bonds because it's not going to want to be as risky. It's not going to have as much market volatility and have to have as much time to try and regain back. So it might hold like 80% bonds and 20% stocks. If you buy a 2060, that's 30-some years. That's a long ways out, 40-some years. Now it may hold like 90% stocks and 10% bonds because it has time for volatility to happen, okay? I personally would not say buy any of those target date funds. If you're in a 401k and you have the mutual funds, individually pick the mutual fund sectors to buy. Decide if you want to go stocks, you want to go bonds, a combination of them, but don't go with the target date. They're just not going to really perform for what you guys are probably going to look for, and they have even more management fees, right? So I think that's the most important part of the stock market. Questions on it? Any concerns that you guys have had or you're not sure of?
Patrick, where does the T-bill fall?
So a T-bill is going to fall under the bonds, okay, but that's a government treasury. So there's government and there's corporate. And our government actually had never ever bought any corporate bonds at all. Never participated. Just only sold the government bonds until COVID. And Jerome Powell actually for the first time bought corporate bonds, and it really threw a lot of things upside down. So REITs are a little bit popular too. That's real estate investments. Yeah.
Are you talking anymore about annuities like fixed and index?
That's going to be next. Yeah, because remember there's banks, stock market, and insurance. So that's what we're going to talk about next. So those are the three legs. Yes, ma'am.
You said that the government bought the bonds. Right?
Corporate bonds.
Corporate bonds. Who decides to do that?
So they wanted to try and go through and help the corporations out. So it wasn't a thing that they were trying to make money. So we actually made an offer to buy corporate bonds at 0.25% interest. So that kind of screwed all of you guys up, saying, well, I wanted my Walmart bond at 4.5%. I've always liked them at 4.5%. When Walmart can borrow the money at 0.25% from the government, they're not going to borrow your money. So it really threw things off for quite some time, but the bonds are starting to really get back in sync and be back because you can't borrow bonds of that kind of money anymore, and a lot of those have been callable or gone, right? So insurance companies. Why would somebody do an investment with an insurance company? And I love to ask this question a lot of times when I meet somebody, what do you think of annuities? And a lot of times people will go, I hate annuities. And I love to say, why? And they don't know. Or the answer is, because my dad hated them. So There are some things that happened in the past that the insurance companies were responsible for that don't happen anymore, okay? And I'll kind of cover some of that as we go through. But they will protect the principal in most cases. So when you have some type of an insurance product, it's not going to go backwards if the market does, if it's the right type of product. There's only one that is not protected, and I'll cover that. They give you income opportunity. So in retirement, insurance might be a really, really good solid tool. So we talk a lot about the three-legged stool. The three legs are going to be your personal investment, Social Security, and a pension. If you don't have a personal pension, you can make one on your own through insurance products. Okay? They have moderate interest accumulation because of the fact that the insurance company has to make some money. So they're going to carry some of the risk. So they're not going to share all of the reward with you. So it's moderate investment. And they have legacy planning where you can go through and leave a lot of money to your heirs. And a lot of times you can leave it tax-free. So they work really, really well hand in hand with the IRS. Two types of investments through the insurance company is annuities and life insurance. Okay? The life insurance, this is where that IRC 7702 comes into play, where we talked about that mega Roth, because it is a life insurance policy. So let's talk about annuities, types of annuities. You have immediate annuities and you have deferred annuities. So remember when I talked about the fact of the trust, and all of you guys in here would have a revocable trust at this point. You probably would not have an irrevocable trust and gave up control of your own assets. You probably would not have an immediate annuity, okay? Because the immediate annuities are normally put in place to go through and qualify for some type of government benefit, whether it be veterans benefits or Medicare or Medicaid, type thing where you're trying to bring income down. That's where an immediate annuity comes in. But the single, joint life, and period certain I'm going to cover because they're very similar to the choices you'd have if you have a pension through work. Okay? So let's just touch on them quickly. Single life means that if you take that annuity and you want it to send a payment to you for the rest of your life, so you give the money to the insurance company, and now you're asking them to pay you a payment for the rest of your life, you're a single life. Okay? It's going to pay you as long as you're alive, so even if you put $100,000 in and you live long enough for them to send you $150,000, it never runs out. You get that payment as long as you're breathing. Okay? Now, if you died prematurely, because that's always the question, I put $100,000 in, I get smacked by a bus and die tomorrow, yes, your beneficiaries get the $100,000. It goes back to them. So at any point, if you pass away before you've exercised all the money you put in, that money goes back to your beneficiaries. Okay? That's part of the problem that in the 70s and prior was not the case. If you put the money into that single annuity and you turn around and get killed the next day, the insurance company kept the money. Okay? They kept it so they could help lower their fees to make insurance better for the future was what they would talk the game. That's where people, your parents' age, started heeding insurance contracts. And so those are not sold at all any longer, but I'm not going to say that they're not still out there, because people sometimes bought those way back then and they still might be around. Okay? Joint life. Well, that's pretty easy. Husband and wife buy it. If the husband passed away, the wife keeps getting the same payment. If the wife passed away, the husband gets the same payment. Same thing goes if you both pass away before you've utilized all the money you put in there, your beneficiaries get the difference. But you could live long enough, one of you could live long enough, that you've actually gone and used the insurance company's done, right? Period certain. So, we did this case today with somebody who offered this through Federal Express. He was a driver for FedEx and just retired. And so his options were to take single life, to take joint life, he's not married, so no case on that one, or period certain, and he has a daughter. So his choice was he could take X dollars, we'll call it $3,000 a month for single life. Or instead of $3,000, he could take like $29.50, so $50 a month. He could take a period certain for 10 years. That means that if he dies within the first 10 years, his daughter would get the exact same payment he was getting per month for the remainder of whatever's left of the 10 years. So he does that one, he passed away 4 years into it, she still gets 6 years of payments, then the contract's done. Okay? That's a period certain. In his case, we had to pick a 15-year period certain, so it was a little bit of giving up about $65 a month, but if he passed away, she's going to get the remainder of those payments for the 15 years. And the way I looked at that is that if he turns around and makes it 15 years, and we do the math, he's pretty much pulled out all the money he ever put in here. Okay? So it's just kind of a break-even point on that. But that's how period certain works. Questions at all on that? All right. Deferred annuities. There's two types, variable and fixed. Where I said on the last page, there's only one insurance contract that could go backwards. And I would tell you, do not ever own it. And if you have it now, see if you can get out of it. And that's anything that has the word variable. Okay? They're very, very tricky with how they do things in variable contracts, but everything in the contract is at risk. The asset's at risk, the payout is at risk, all of it. I would never do a variable annuity or variable life insurance. If you have a variable, you want to have it looked at to see what your options are of moving out of it. Fixed is much better. On a fixed side, there's two. There's index and there's fixed. So the fixed is kind of like a CD, right? So you can turn around on a fixed annuity and say, all right, I'm going to go into this for 5 years, and the insurance company is going to tell you what kind of interest rate they're going to give you. You're going to get that interest rate for the entire 5 years, and in the 5 years, you get all your money back. Well, that sounds like a bond, right? CDs are the same thing. You put money in the CD, you're going to get that money for however many years, and at the end of the time, you get all your money back. The CD matures, right? So CDs, bonds, and fixed annuities, they're all the same. All the same. CDs, if you need to liquidate it prematurely, a lot of times the banks now will keep 6 months worth of interest. A lot of times they'll charge you like a $60 to $100 processing fee, and we're now seeing that a lot of the banks are putting like a 1% surrender charge. If you're going through and doing it with a bond, the bond only risk is that you might sell the bond for less than you bought it for, okay? So if the new bonds are paying higher interest, nobody's going to want to buy yours. So you have to sell it at a discount. So that's kind of the risk of selling a bond prematurely. But if the new bonds are selling for less interest than you have on yours, you could sell it for a premium. So bonds are pretty cool. The insurance contract, they have surrender charges. So that is a negative. And so a lot of times they'll have like a 5% surrender charge the first year, then 4, 3, 2. So you have to just look at it and see what kind of surrender charges. So you really want to do a fixed annuity if you don't need the money for that period of time. But they're going to give you the most interest guaranteed out of those three vehicles. Okay? So they usually pay 2%, 3% above a CD, and they usually pay about 2% above a bond. It's just the time that you have to hold it. This is the one that is really easy for planning. Okay? This is the one that we use a lot for our clients as far as understanding taking income in retirement. So we're talking about the three legs: Social Security, your personal assets, and building a pension. If you don't have a pension through work, that pension through work is not going to cover as much of your essential expenses. So let's say that your expenses are $5,000 and your Social Security is $2,500, and we have a shortfall of $2,500. How much would we have to put in here to get $2,500 a month? And that's the big question. Because the interesting thing about an indexed annuity is that it can never go backwards. It's guaranteed against market risk. But it gets market returns. So if the market happens to go up 5%, 5% gets added to the account. If the market happens to go down 5%, you just don't earn any interest for that year. But the interesting thing is if the market goes down to 5%, your investments don't go down 5%, that you have to earn more to get back up. It draws a line in the sand where you were, and you stay there. Okay? And it draws a line in the sand based off of whatever the account value is at that time. So you put $100,000 in, it grew to $150,000, and now the market went backwards 10%, you have $150,000 starting the next year. That's why it's easier for planning, because of the fact that you can go through and utilize that setup. In this particular case, they also do what they consider the hybrids. Okay? So there are index annuities out there that you can purchase that will not only grow tax deferred, but they'll also give you income for life as a pension. And then they'll also have like long-term care enhancers on them. So there's a lot of them that if, let's say, it's going to start paying that $2,500 a month, and you end up having a couple of challenges, which there's 6 ADLs: eating, bathing, dressing, toilet transferring, and incontinence. If you have challenges in 2 of those areas, that contract will go through and double that payment to you for like 60 months as a long-term care enhancer. I don't like calling it a long-term care policy, because if you're getting $2,500, now it's going to increase $25,000, so you're getting $5,000 for 60 months. That $2,500 might not help you truly pay for the house. But it's an enhancer. You could definitely put a dent in it, right? No proving insurability either. Anybody can have them. So the only rules they have on that, because like let's say, oh, mom's in assisted living, I'm going to buy that right now for mom, and then we'll turn that puppy on. So you have to have it for 2 years, 24 months before you can do the increased hands payouts. And a lot of them you have to have it for at least 1 year before you can turn on the income. Kind of cool way, like I said, to go through and build that third leg, that pension, is by using that index product. Okay? Talk about life insurance, because there's 4 types of life insurance. What's the one that we would not want to do? Variable life, because everything on it is variable. Okay? However, whole life, very popular for people to buy for their kids, right? They might go through and when they're first born, buy a particular policy, and like it's going to come and then be of a certain value at like 25 or 18, or maybe you write it out to 65, whatever you choose. Just understand the whole life is not your life. The whole life is the whole life of the contract. Okay? So, what's interesting about a whole life policy is they're very, very clean to understand. If you are 40 years old right now and you want to buy a $100,000 policy in whole life, what they're going to go through and do is they're going to figure out how much the premiums are for a 40-year-old, how much the premiums are for a 100-year-old, and then they're going to average that cost out. And you're going to basically pay that amount that if you hit 100, you're going to receive the $100,000 back in cash because you're still with us. If you die between 40 and there, your family's going to get $100,000. So, if you only paid into it for 2 years and you die, your family wins. It's kind of a joke, because you don't. You're gone, right? But that's how that works. Now, it's not exact math. You're not actually paying the exact premium all the way through because it gets like 3 to 3.5% interest. So you actually will pay in a little bit less than the $100,000 over that period of time, but nevertheless, you'll get $100,000 back if you hit that age. But you choose the age. It might be that you want to run it to 65, you might run 90 to 100, 110, they're now running them out to 120. That's all the thing that our grandkids will now see 120. That's scary. Yeah. All right, so, yeah. So that's how a whole life policy works. No ability to borrow money on it or to do any type of anything else. It's just straight life insurance. So it's really kind of like a long-term term policy. Universal life and index universal life. They're basically the exact same product. The index universal life is what is used for the 7702. So again, the IRS says, hey, this is the one you can use because of the fact of how it calculates things. So let me explain. The universal life policy is kind of like that annuity. When you put the money in, your investment can never go backwards. It's an up elevator with no down button. Now there is cost for the life insurance on this, whereas like the annuity, there's no cost because it doesn't have a life insurance feature to it. But the money that hits the savings account cannot go backwards in either of those vehicles. But the difference is the universal life, the rate of return is calculated based on the internal rate of return of the insurance company. And I'm not going to say that any of them are fraudulent or are going to mess with the numbers, but you can't really go on the internet and put in the ticker of the insurance company and see where their profits are for the year. The only way you know what you're going to get is once it goes past your anniversary and they report it to you about 2 weeks later. I don't really like that idea. The index universal life policy is based off of an index. And you can go to the computer and look up the index and see exactly where the index is for the year. So let's talk about an index real quick. On the news, they talk about the Dow was up today, the Dow was down today, right? What is the Dow? The Dow is the top 30 companies in our country. Is that really a good barometer of how the market did today? I don't think it is, just looking at 30 companies. What is the S&P? Well, it says in its name, S&P 500. It's the top 500 companies in the country, and obviously the S&P 500 holds those 30 companies also, right? What's the NASDAQ? Top 1,500 companies in this country. So it's up to you how you want to look at it. For us, our investment group, we look more at the Dow because the Dow represents more about like what we're doing. We're not as diversified as the 1,500 companies, so we're more on that side. But if you've looked at the Dow numbers, most people will look at the green and red numbers, right, which is either down if it's red, it's green if it's up, And they freak out about that on a daily basis. Next to that, if you happen to notice, there's some black numbers. And they're much larger. Like right now, it's at like 4463, we'll say. Okay, the S&P 500. What is that number? Well, if you took and wanted to buy one share of all 500 companies, okay, so you bought one share of all 500, added that together, divide by 500 is the average cost of share. Well, that's a much better barometer, because if you watch that, that would let you know what kind of movement we're really having over a period of time. Earlier this year, they said there's no way the S&P 500 is ever going to see 4,500. Well, it saw 4,600. Okay? They were wrong. So that's the thing to look at. But what they're talking about in these insurance contracts of the index is, let's say that you buy life insurance or an index annuity, and you're basing it off of the S&P 500. The day that you buy it, it's going to take a snapshot of that, say 4,400 where it is today. Today is September 19th. We bought it today at 4,400. What is it September 19th next year? If September 19th next year, it's at 46, then all they do is subtract that 200 points, divide that 200 points into the 44, and whatever percentage of that is, that's the percentage of interest that's added to your account. If we bought it at 44 and next year it's at 38, well, that's a huge loss, so your account would just stay even. It wouldn't go up, it wouldn't go down, it stays right where it's at. Make sense? So I kind of like the index because of the fact that I like going to the computer and being able to see, if I bought it today at 44, kind of where is it at throughout the year. It's not going to help, you can't do anything about it, but it's still kind of nice that you have a little bit more control over it, kind of get an idea of whether you're going to pull money from that later on or you're not, right? Term insurance is very, very easy to understand. It is the most coverage for the least amount of dollars, right? So if there's husband and wife, they've got little kids running around, and I love it when I used to sell a lot of life insurance, and you'd go to a house. You women are going to love this one. I don't know about guys, but I'd go to a house, and the man of the household would say, I need $500,000 worth of term, and I need $100,000 for my wife. Well, why $100,000 for your wife? She doesn't work. Okay, she doesn't work. But she grocery shops, she takes care of the kids, she does the schoolwork, she cleans everything, she does your laundry. And so basically, if something happens to her, how are you going to do all those things, and who's taking care of the kids? How about we take 500 on her and 100 on you, because you're not worth as much, right? But that's not how they think, and that's funny, because they're thinking just of being the breadwinner. So you would take insurance on yourself to protect your kids because they have no income. So the point is, if somebody's relying upon your income, then you probably would take term insurance, right? And you would take the term insurance for as long as they're going to rely upon your income. So if you've got an infant, state of Florida, at 12, they can take care of themselves. So if you feel comfortable with that, maybe you take like a 15-year term policy, right? Okay? Tony and I own a body shop together. Tony's a body man, I'm the painter. But he is an extremely good body man. And we're both married, and we own the shop together, right? So he takes 50% of the profit, I take 50% of the profit after we pay everybody. But if Tony were to pass away, I would probably have to hire 3 body men to do what he can do. So I'm going to be out at the expense of hiring 3 different employees, right? And I still have his wife to deal with, but she's still going to want half the money, right? I mean, that's a business. So Tony and I come to an agreement of what we feel the business is worth, and we sign a buy-sell agreement. Now, I'm going to pay for your life insurance, and you're going to pay for mine. Because if I mess up and don't pay your premiums, then I owe your wife, right? But if I'm paying his premiums and he passes away, his wife is getting that life insurance face amount tax-free. It's her money, and I own the business 100%. And then I can take his money. Let me just turn on the trash. And he can collect trash really loud. So at that point then, I have that extra money that I was giving him 50% of to go through and hire those 3 bodyguards. That makes sense? So that's a buy-sell agreement, and we would go through and do that between each other. But we wouldn't have our business pay it, because if the business pays for it, the benefit to your wife or to my wife, then is taxable. But if I pay it, you pay mine, the benefit is tax-free. Okay? So those are some of the reasons to go through and do a term policy. Right? So, we talked about the differences here of having cash, stocks, or bonds. There are 9 different sectors that make up the stock market. So, if a company wants to borrow money from the stock market, it's going to fall into one of those sectors. Is it utility? Is it technology? Okay, it's going to fall into one of those sectors. This chart here, which is not in color in your book, this chart shows each of those sectors. And sometimes people will chase a sector. Okay? So, I love purple, so let's pick the purple one. All right? Right here, the purple one. So in 2003 is when this chart started. So 2003 to 2022. Let's just kind of follow what the purple one did. So it was kind of towards the bottom, because I would say this is about the medium, right? The next year, it didn't really move up or move down. It stayed the same. The next year, where did it go? Next year went to the top. It was the #1 pick for that year as far as its particular holdings. Where did it go the next year? Well, the next year, crap, it went to the bottom. Right? So we're here, spiked, right? And then from here, it went back at the top. Then it went to the medium. Then it fell down to here. Then it came back to here. But then it went, the bottom. Ah, crap. 5 years on the bottom. Right? And then it shot back up. Then it went here, 2 years down, up, down, up, up. So I was a commercial pilot. And it's funny that Michaela's here, because both of us are the same. We like turbulence. She does a lot of flying to her country, and so she loves getting the airplane a little bit of bounce, puts her right to sleep, you know. And so it's just, turbulence is nice. Now, you guys may not like it, but I think it's great. But it's just kind of a nice little chop, right? So I took off one day out of Fort Lauderdale, and it was very heavy. Heavy means that I had enough cargo and fuel on board that I could not go back and land, because I would actually crush the landing gear. The airplane weighed so much. That's taken off heavy. So if you have to make an emergency landing, you have to pull what's called waste gates, and you have to dump all of the fuel and land without fuel, because that should lessen the weight that you don't crush the landing gear. So I take off out of Fort Lauderdale. I'm cruising on out. Myself and a first officer. We have our flight bag in between us, actually my flight bag in between us, that has all of my maps or sectionals in it, right? And they give us some vectors to go around a storm that's just over the Gulf Stream. So we're not very far out of Fort Lauderdale. And we're climbing out about 10,000 feet, and they give us these vectors right into the center of the worst part. Like I talked about my umbrellas today collapsing. This aircraft all of a sudden dropped almost 11, we were climbing out 10,000, but now we dropped almost 11,000 feet in a split second. And then we shot back up almost 15,000 feet. I mean, it was insane. It was so insane that my flight bag went through the windshield. So we were now flying in the total wind and rain, and we had to turn around, dump all the fuel, and go back and land. That's a bit too much, okay? That's kind of this number. Slam, 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 right? And that's not what we want. We want to try and have it steady. So another analogy would be if you like boating, right, and you go through and look out at one of the seas today, or if you go on cruises, you know, you might be okay with like a 2-foot to maybe even a 4-foot chop, okay? But when it starts getting over that, it starts getting really, really uncomfortable, right? We did a cruise one time from Canada to Hawaii, and we were in 75-foot waves. I didn't even know God made 75-foot waves. We were on a cruise ship, and thank goodness they were called rollers, because they're not breakers. Breakers are really dangerous. These were just rolling along. But it was the first time I was ever on a cruise ship that you could stand outside and actually go all the way down to the bottom and see water all the way around the ship. And you go all the way up to where it didn't look like there was any water. You were just looking all the way up. It was the coolest thing. My wife and I don't get motion sick whatsoever. We loved it, and it was 3 days of it. Everybody else on board, including crew, were totally sick. You, to eat, had to hold on to your plate. You didn't pour anything to drink. You just had to hold on to your plate and try to eat while everything was moving. To walk down the stairs, you leaned against the wall, and then you leaned against the other. I thought it was really cool. It was a neat experience. Most people didn't like it. It was just way too much, right? So again, there can be just way too much turbulence out there. So the whole idea is, how do we invest and not have these ups and downs and these massive swings, okay? So there's 2 points to that. One, if you only have your money here, and we're building that 3-legged stool, so we now have Social Security and investments, that's the only 2 legs we have, and you're trying to pull your retirement money out, and you're okay starting out here, and then it's here, you're pulling out principal, you're not pulling out interest, right? When you hit up here, now maybe that's a good time to pull out because now you're pulling out interest. I'm saying, you know, the interest rate, but you're not touching the principal, but then all of a sudden it slams it. So that's not real helpful to be able to have a good plan of money coming out of them on a regular basis, right? Because the idea is you want to live on the interest, not the principal. So the black boxes that we did not talk about is how we go through and do the investments to try and maintain that median style. And that's what I'm going to talk about next. So the goal is not to hit the rock bottom, but also we know we're not going to be number one. Okay? So we'll give up that higher end performance to not have that major drop. And you'll see why that can be important to not have that major drop because it takes too long to recover back. So this is the average portfolio structure that most investment advisors go through and do with people, or people do on their own. This is a real investment strategy set up in 2008, and they went through and picked these different sectors in this position, so those are the different holdings that it had, and they set it up to be heading towards retirement. So there's a thing called the rule of 100, and that is you take your age, subtract it from 100, okay? So the difference between your age and 100 is the percentage you should have in the market. And the age you are today is the percentage you should have protected. Okay? So protected and risk, the most amount of risk is a score of 99. The most amount of protection is a 1. So if you go into a money market account, it's a 1. You go into a savings, it's a 1. You go into the annuity contracts, it's a 1. But if you turn around and you decide to go buy one stock, depending upon that stock, it could be rated up there. So Apple would maybe be rated around a 63, okay? But you could buy a stock that could be rated at 99. So you lessen your risk score by diversifying over, right? And so I like to call them speed limits. And one of the questions they'll ask on here is, have you had your speed limit evaluated, or have you had your portfolio evaluated? And it's a speed limit. So if you have it evaluated and your average is a 90, well, you can't make super fast decisions going 90 miles an hour down the road. Maybe you might want to lessen it down to like a 50, so you could make a little bit better decisions, have a little bit more time to make decisions, right? Okay, so this is trying to help out with that speed limit, and it's going 60% stocks, 40% in bonds. This particular portfolio over this period of time of 1 year lost 24.82%. This was in 2008. So a lot of people got really discouraged and they said, I'm going to go hire a professional because maybe I just need to be diversified even more. So they went ahead and they diversified more, and they went through and they bought more of the sectors of the market and thinned it out quite a bit more. And this could actually be too diversified, over diversified. But what's crazy is that this lost 28.2%. And then the thing to point out is the very next 2 months it lost another 17.9%. So this lost like 47% of your investment in 14 months. Okay? If that were to happen, how long would it take for it to come back? What would you have to earn for it to come back? Well, right here, if we lost somewhere around 46, 47%, we would have to get greater than 67% return just to get back to even. That's why we don't want to have those huge drops. We don't want the windshield to bust out or to be able to see water all the way around us, right? You want to try and be in a little bit better, stable environment that you're not going down so far. So everybody always tries to look for that number one deal, shoot for the stars, but it's much better to actually look for protection and not ride down so you don't have to climb back out, right? Warren Buffett, and I've lived my whole career by this. Rule number 1 is don't lose money. Rule number 2, don't forget rule number 1. Okay? I'm not a financial broker or financial advisor. I'm a financial planner. There's a massive difference. We're doing planning to make sure that we're going along. So we're talking about all 3 different areas and everything that's encompassing with it as far as taxes and all, okay? A broker would just sit here and talk about the market, what's going on, and how to get volume out of the market. Okay, so there's a big difference there. These are the types of investment strategies, okay? Now, one that's not on here is buy and hold. So buy and hold is probably what you've done at work because you probably picked your funds in your 401ks and you haven't made any real changes. You just stayed in those 401ks, or you stayed in those mutual funds, right? So that's a buy and hold. And over a great period of time, it works. You probably had a lot of ups, a lot of downs. You know, a lot of people just say, I put those statements in the drawer, I don't even look at them because it makes me sick when it's down, it makes me happy when it's up, so I just don't look at it. I don't need it anyways for another 20 more years when I retire, and that's fine, that's a buy and hold. But now you guys are at a point, except for Josh, shouldn't be at a buy and hold, right? And he shouldn't be either, because he's smarter than not to be. But, I'm going to say because of his age, so really him and him. But, they're a strategic, so active management. So you can actually hire groups that will actively manage your portfolio. So like during COVID, would have sold those holdings, would have broke that ETF and sold out of those and then rewrapped it again. And even on that side, if you think about what happened with COVID, is if you went into like say, we can use Royal Caribbean again. Royal Caribbean, we sold out when it was up. It went down because of COVID. We would buy back into it. We actually maintained and grew out pretty decent. But then fuel started being a challenge, so we dumped out of it again as fuel prices started going up. You know, if the price of fuel goes up by 1 penny a barrel, it costs the airlines over $800,000 more to fly that day. Hence the fuel taxes. That's why they put all those fuel surcharges on your airplane tickets now. So you buy a ticket a long way out, and you know, man, look at the great price I got on this thing. Get closer, you have to pay that fuel price because it all depends upon where that fuel is. Okay. So strategic is very, very decent for trying to keep you in like that middle zone area. Tactical. Tactical sounds military. It's where you have somebody who's actually jumping in and jumping out of the market or timing the market. So if they see something is going to come up and cause some type of a negative return, they will sell and go to cash. And then when they feel that the strike is right, they will buy back into the holdings. Now, the risk with this one is if you're doing it with your individual personal account or joint or trust, it's not an IRA, not a Roth, right? Because an IRA is all taxable, a Roth is not taxed at all. But if you're doing this with your personal account, that could be an issue because they may not hold the holdings for very long. They might actually jump in and out of the market 3 times in one day. They could cost you a tax bill. So be very careful what you use this strategy for, but it is very, very productive, and I'm going to show you that in the next slide. And then this alternative is going into investments that don't have anything to do with the stock market at all, okay? During the end of COVID, we started going through and doing various different things with alternatives where, with doctors, if they had a bunch of people that were sitting with Medicare and Medicaid and then they had to wait for their payments, we would buy those. We would give them money to buy their holdings from the government. So if they're waiting on $120,000 to be paid to them from doc pensions they've already seen, we would maybe give them 95% of that, and then we would wait to get the other 20. So we'd make 5% waiting, or we'd make 10% waiting, okay? Dan, who is on our other coast, actually used to do that for a profession. It's called factoring, and he used to actually be a factoring investor. But that was one of the things you do. You can do it with art, you can do it with music, you can do it with all types of things. Alternatives would also even be like the insurance products. So there's all types of ways of doing alternatives, so all kinds of investments that do not use the stock market at all. Okay? This is the tactical slide I wanted to show you. And the thing I think is pretty cool about this is that this is from 1872 to 2014. That's a pretty good span of history, right? And what it's showing is that this is the S&P 500 in the blue, just buying and holding, staying in the S&P 500. And the yellow is a tactical manager timing it to jump in and jump out when they felt that there was things coming up, that they would get out, and then they felt the strike was right to get back in, okay? And the thing I'm going to point out is that there's 80%, 90% of the time, 95% of the time, 99% of the time. If you look at the difference between the spread, it's about 2% more. So tactical investing done on this, it basically outperforms the buy and hold situation. So that's all I wanted to see. Okay? When most people don't even know what tactical is. This is the biggest issue when you decide to go through and start doing something on your own. Okay? And too many people, and this was interesting, during COVID, they made some changes to your 401k. So the Secure Act did. It used to be that you pretty much could not make a change but like once a year on your 401k. So if you wanted to come out of the market and go into your money fund, you couldn't go back into the market until your anniversary date. Then they went through and opened it up that you could do it maybe 2 times a year or 3 times a year, okay? During COVID, they relieved all of those rules and you could day trade your 401k. It was horrible. It was so horrible that we actually had to create new software to come up and be able to read what was happening in the market to see if it was just people day trading their 401k or if like Warren Buffett was really making a decision and we missed something. Kind of crazy that we had to create this software to actually track that. But they were moving the market so much. And this is what ends up happening. Person who grabs a hold of their 401k or their investment, they're going to hand themselves, they're a little optimistic about going through and doing it. And you have this in your book too. And then they go ahead and the market goes up and they get really excited. They're like, man, I should have done this years ago. What do I need a professional for? I should have been handling this the whole time, right? It goes up even more and they are thrilled. Thrilled. And then it hits the top here and they're just can't handle themselves. They're so excited, right? This is what's crazy is that this is the most dangerous part right here. The most dangerous spot, and they don't even know it because they're thinking they're sitting on top of the world. Because from that point, it starts to decline. And as it starts to decline, they start going through denial and fear and then panic and then total depression. And they start sitting down here and they're going, is the bottom ever going to stop? Am I going to lose everything? And a lot of times they sell. They sell out at that point, right? If they don't, they start to come up and all of a sudden they have hope, right? And then they start getting into, where they start feeling, they start feeling relief from it, and then they're back to the optimism, and they go, you know what, this was stupid. They take the money out, they go, I'm never playing that thing again, right? But the point is, this is where you should buy. And everybody says buy low, right? As far as myself, I am unbelievably greedy. Super, super greedy when it's down there because everything's on sale. And when it's here, I'm panicked. Panicked because now I don't really know which route should I go. Should I sell? What should I sell off? What's going to start to drop? Because it's going to drop from that point. Okay? And yet they're playing it just backwards. A lot of times they're buying in here and then they're selling there. And all of a sudden the thing comes back up again and they buy back in and it goes down and they sell back out. And they're doing it just backwards. Hopefully that's none of you guys that you did that. If you did, I'm sorry. You did it, do it backwards. And that can be really, really costly. So you have to understand that depending upon what type of a holding you're in, it's probably not going to go away. Did you know if you're in an airplane and you hit pockets of turbulence, the airplane will not hit the ground? It's impossible because the airplane going down as it's dropping so fast, it's creating air current underneath the wings. And all it has to have is something to reflect the wind off of, being the ground. And as soon as it hits that ground effect, it's going to push it back up. Okay? It's really the same thing here. It feels like it's never going to end. It feels horrible because it's going down. And it feels even worse if this is the only place you have to draw your retirement from, that and Social Security. Because then you're like, man, I can't do anything this year. I'm so strapped. I'm starting, and you're in the principal. So it's tough. That's why I want to build that three-legged stool. With this, I'm going to talk about Sharpe ratio. Dr. Sharpe created the Sharpe ratio back in like 1969. He won the Nobel Prize for it. He's actually still teaching today. And it's just another way to take a look at risk of a value of portfolio. Okay? So they say the closer to 1, the less the risk of the portfolio actually bottoming out or jumping up to high numbers. But before we get into that, just math, talking about math, you see the returns on this, negative 12, negative 22, 28, da, 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 da. So there's some negatives, there's some positives, and it averages out to 8.59%. If we are not putting any money in or taking any money out of this, and we go ahead and flip these numbers or just shape these numbers up so they're all in different orders, are we going to get a different answer of 8.59 or we get the same answer? Same answer. Because all they're doing is adding these together and dividing by the number there is to get the average rate of return. That's what an average rate of return is. Okay? Now, you go to pick a fund in your 401k, most people will go, okay, what's been the rate of return over 10 years? Well, that one's not that good. Well, that was really good. That one's really, and they'll pick the one that's done the best, right? So this one has done 8.59%. This one has done 8.5%. So it's down a ninth or a tenth of a percent, right? So most people would pick this one versus this one. But I'm showing you the Sharpe ratio that I said the closer to 1 is less risk. So even though this is at 8.50, it's at 2.1. This is at 8.18. So this is a higher risk portfolio. But usually you don't get the opportunity to look at the Sharpe ratio. You're just looking at those rates of return. So as they're growing, this one that did 8.59%, we put $500,000 in there, okay? We're not taking any money out whatsoever, and we're looking at where the balance is growing to. So at the end of this period of time, it's worth $2.1 million at 8.59%. Not bad. Love it. When we look at this one that did 8.50, look at where it's at. It has a better Sharpe ratio, so it didn't have as many of the negative purples. It has less purples, right? So now it comes out to 2.7. This was 2.1. So a $600,000 difference over that period of time, just because it didn't have as many downstrokes. It didn't have to try and recoup back up as much. If you see, though, it didn't have as many or as boasting high numbers as the other one did. Okay? So if we now, though, start to do a sequence of withdrawal, because that's the big kicker of where you guys are going into retirement. Now we can't change the numbers. Now we're going to look at where they're at this 8.59, and we're taking out $24,000 with a little bit of a COLA or inflation on it each year. As we do that over that period of time, we end up with $246,000 in this account at that period of stroke, right? That's the one at 8.59. What if we do the exact same withdrawal with the exact same money over the exact same period of time, taking it right on out, same, all same, 1.4 million. Guys, that's a difference of $1.2 million. Sequence of return is the kicker. If you have just the two legs, Social Security and investment, and you have no choice but to take from your investment, you're really handcuffing yourself. Because there's going to be ups and downs, there's going to be swings. You need to build that third leg in, so if you're in the situation where the market is down, you don't have to take from the market. That make sense? So, what did we learn in this section? There's different types of investment strategies, right? We have banks, insurance companies, and the stock market. So, you need to take a look at how should you be invested between those three different entities. It's important to have a realistic understanding of how the market actually works. Don't just go out there and try to shoot for, the key numbers. What do most brokers talk about? The greatest rate of returns last year, the greatest rate of returns in the last 6 months, the greatest rate. No, we're not trying to shoot for those. We're trying to ask what's been the most stable over the last 6 months, what's been the most stable over the last 3 years, right? Because you don't want to have that drop. You're better off having a smaller growth to not have that larger drop. And it says, consider working with a fiduciary professional service instead of trying to do it on your own. Now, what we want to go through as our action steps is establish your protection ratio, right? What speed do you want to be running at? Compare the commonly used traditional allocations as far as tactical, buy and hold, active management, those, and see how that would blend to go through it and help you out. And determine the optimum blend of investments of all three buckets that would best work for your scenario. Okay, so we're starting to put all of it together now. So the next section we'll talk about how to actually get money out of these vehicles. So if you would, grab the sheet that she gave back to you today and just answer the next 4 questions. Was it ready, Tony? No? Answer the next 4 questions on here. All right, so I thought I was going to have 2 that come in to help out with setting the lab session. So we're going to have Michaela. She'll help get it going if she misses you on the next one, she'll get you at the end of the night.